So then, why do companies manipulate? Well, to look better. Looking better attracts clients, attracts employees, suppliers, bankers. Sometimes you have to manipulate just to survive, as otherwise you are bankrupt. Of course, you also manipulate for monetary incentives, to get a bigger bonus, to increase the share price because you hold shares, or simply not to get fired. Poor performance is the primary reason as to why a CEO gets fired. Of course, you also manipulate to look good on the golf course. This sounds silly. Yeah, it is silly, but a lot of CEOs are silly, with big egos and childish behavior. What are the risks? You get caught, you go to jail. Going to jail happens very rarely. You pay a fine. CEOs can pay fines. They are rich enough to pay fines. If you are caught, you are humiliated. Okay, that is also okay, since on average, you still get to live the good life. The penalties of earnings manipulations are not very high, and not many people get caught, and only a tiny small fraction go to jail. CEOs have a lot of reasons to manipulate, and few reasons to be completely ethical. Which accounts are easy to manipulate? Well, a lot. Let me list a few simple ones. Assumptions about bad debt. You can increase or decrease bad debt expense by changing assumptions about future customer payment patterns. Inventories. You can manipulate the lower of cost or market rule. You will not impair even if proper ethical accounting tells you that you need to take an impairment on the income statement. You can also decide when to ship the products. There is an example when a company in New Jersey receives an order in December to ship products to a client in January. The company really wanted to book sales and earnings in the month of December because they were having a bad year. So they shipped the products in December anyway. But they ship it using a ship and not rail, and they ship it from New Jersey to Tokyo to California. The auditors come in, checks the warehouse, there's no inventory, they see a purchase order, they say it is all fine. This is correct accounting. There is nothing that stops the creativity of a manager when the person is looking for a nice bonus. You can also manipulate using long-term assets. You can manipulate the years of depreciation, the salvage value, the revaluation which is allowed under IFRS. We can manipulate writing down assets if there is an impairment, and the timing of sales of such assets to recognize gains. The list is long and really long. You can also manipulate financial assets and liabilities and others. The SEC website offers us a wealth of knowledge when it comes to understanding financial manipulations. They regularly publish accounting and auditing enforcement releases where the SEC punishes and fines companies for accounting violations. You can find these on the SEC website. Let me give you some examples. Recognizing too much or too little asset impairment. One company was not willing to write down an impaired non-operating asset, so income was artificially high. On the other hand, another company preferred to impair once and take a hit as it was a good year rather than depreciate over a long time since it would slow and lower earnings over the long run. In another instance, a company develops software and allocates internal salaries unrelated to R&D and software to capitalize software costs. So expenses disappear from the income statement and they show up under assets. Modifying depreciation or amortization of an asset is another way to manipulate income. One company inflated the estimated useful lives of assets acquired due to purchase business combinations. Hence, there was a lower hit in the income statement since the depreciation years were longer. In another example, a company depreciates fixed assets at an accelerated rate in periods of strong earnings, overstating depreciation expense and understating fixed assets. Some more examples here. A company uses bill and hold sales. The company enters into sales agreements with a customer, and instead of shipping, they would segregate the goods in a separate location until the customer requests delivery. This way, accounts receivables increase, sales and earnings increase, and inventories are understated. This is one of my favorites. The company manipulates cutoffs. At the end of quarters, if budgeted levels are reached, the manager prevents raw shipments and does the shipping in the following quarter by creating excuses to clients. Sorry, I cannot ship you today, but it's coming very soon. Finally, one company manipulated revenue and non-revenue accounts. When cash is received from an insurance settlement, rather than recording the credit as miscellaneous income, they record credits to reserves for bad debt and inventory obsolescence to show these are part of operations and not as special items. Earnings management happens all the time. If there is the incentive to manipulate and someone can do it and get away with it, then it will happen. Back in 2000, I remember the famous example of Pepsi. They wanted a bit more income, so they said, we have a maintenance program this year where assets are going to last longer than expected. They called it a preventive maintenance program. The longer the assets last, the less the depreciation per year. For Pepsi, that meant 69 million of less expenses, and an income that is higher by the same amount. Well, great, just great. This is not the funny part of the story. The funny part of the story is that in the same year and quarter, Coca-Cola came along and started a structured maintenance and refurbishment program. Again, same drill. We take better care of our assets, they last longer, and depreciation per year is less. The benefit for Coca-Cola? Well, they get a nice boost of $161 million. Is this a coincidence? Is this a coincidence that Pepsi and Coca-Cola do maintenance on their assets in the same year? Well, simple luck. That Coca-Cola and Pepsi had to do it in the same year. Well, not really. If one manipulates look better, the other is not just gonna sit still and watch. How do we catch earnings management? In a study done by the Association of Fraud Examiners, 43% of accounting fraud is discovered if some Mr. Nice person in the inside reports it. The internal audit function discovers another 15% of the frauds. How often does auditing find the fraud? Well, only 4% of the times. Does this mean that auditing is useless? I'm not able to say that today, because we know that they catch fraud only 4% of the times. However, if there was no auditing, would fraud be higher today? Likely. Perhaps even 10 or 100 times more higher than it would be today. So, we believe, or hope to believe, that auditing is a useful function for society. But does society have a problem with auditing? Well, yes, it does. Auditing is not perfect. First, it is very hard to detect clever fraud and manipulation. Also, oftentimes, auditors turn a blind eye. Auditors do not want to upset managers who pay them salaries and consulting services. Also, auditors themselves, at least some of them, are not really white, pure ethical angels. Here is a photo from Reuters. The big 4 auditing firms are under investigation. In fact, they are always in a continuous investigation. If auditors also sell consulting services, can they be good auditors? Is there not a conflict of interest? There is. We all know it. It is time to ban audit firms in doing consulting services. But this legislation is never done. Lobby groups oppose the move. Look at Bloomberg. How about if your auditor was a cheater? Ernst & Young got fined $100 million because it helped its employees cheat on the CPA ethics exam. Hello? Is there something wrong with this title? The auditors cheat on an ethics exam? This is ridiculous. This is ridiculous and beyond belief. What if we read tomorrow that the judges are under the payroll of Exxon and Facebook and Wirecard? Would not that be funny? Well, this is the same. This is beyond ridiculous, really. Look here from The Guardian. How about if your auditor forged audit documents? Well, yeah, sad but true. It never ends really. Always the same story. In an influential study out of Duke University, they interviewed and surveyed about 500 retired CEOs and CFOs as to why managers manipulate. The study remains to this day as one of the most influential in understanding C-suite incentives and manipulations. When asked, why is your company trying to avoid missing an earnings benchmark? About 81% responded that it creates uncertainty about the business. Uncertainty is bad. Bad for business, bad for morale. No one wants to miss a benchmark because of that. Surprisingly, the third response is very revealing. 28% respond that they avoid missing an earnings benchmark because outsiders might think that our firm lacks the flexibility to meet the benchmark. This is quite surprising and actually quite sad. This means that if we miss a benchmark, A, everyone assumes we tried to manipulate as much as possible. B, but we still miss the benchmark even after manipulating. So we must be really bad as a company. This is sad because the way this portrays Wall Street is that there is no room for ethics. How about somebody is simply ethical and refuses to pump into earnings just to make things look good? Well, it seems in this corporate world, there is little room for honesty. No one will think you are ethical, and that is the reason why you missed an earnings benchmark.